You and your practice have dealt more than once with big lottery winners. You told me in the break a $5 million winner and a $1 million winner. What do you do with people who have scored big windfalls all of a sudden like that?
Yeah, so it depends where we're at in the market cycle, but definitely the first part there is the emotional advice, because that becomes tough. You have friends coming out of the woodwork, you have cousins you haven't spoken to in forever that need cash. You want to probably pay down your debt, you want to buy some new cars, and you just have to just take a moment and pump the brakes a little bit is one thing we advise. And then two is the most important thing is cash flow projection, because a lot of times sometimes they want to retire and they just want to stop working and just retire. And then if you're younger still and you're retired, you're obviously spending significantly more than if you're working. So we do a couple things, but we used to just kind of do it on a one-off. But it's not just lottery winners. It could be inheritance. It could be a business sale. It could be a settlement, a court settlement.
Right. You told me you had a very large one that came from a tragic story. That's the residential school settlement. One of your clients received a large sum from that process.
Yeah, so depending on how much experience there is in the market for that individual, you have to just again, pump the brakes. But we used to just do them one-off. Now we have a process in place. The process is, first of all, the classic risk tolerance process. Then once you've figured out the asset allocation, call it a 60-40 or something, you can buy the fixed income almost right away, right? Because fixed income is going to generate. You could also buy, excuse me, you could also buy the alternatives almost right away. If you're buying alternatives such as real estate or infrastructure or any alternative asset class, you could buy that right away. The equities are obviously the portion you want to be legging in. So we will leg in. We looked at some historical data, and we will leg in anywhere over 6 months to 12 months. And we have a bunch of rules that we have in place as well, Paul.
So you identify a portfolio of stocks, and you legging in means you buy occasionally and
correct,
and periodically rather than plunging in all at once.
Yeah. So there's two factors we consider. One is time, and the other is market movement. So if the market is moving in a negative way, we add to the position, and we set pre-established rules: 5%, 10%, 15%, 20%. We're all in a 25% correction. And then on a time basis, generally we'll do kind of 2, 4, 6, 8 months, something like that, or 3, 6, 9 months, depending on the risk tolerance. But it's a plan that's in place ahead of time. We want to remove emotion, right, Paul? Because it's tough to sit there with a large windfall and to say market's down 25% and say I want to buy today.
Right.
But if you pre-establish those rules, and if you look at historical data, it will work out in the client's favor. And we've done the numbers, and we really like the strategy we've developed. And there's way less market timing risk for the client. At the end of the day, you want to protect that capital, and you want to reduce the risk for the client.
What kind of frame of mind are they in? Let's talk about lottery owners. They must be elated. And are they spend happy? Do they have automobiles and cars they want to buy tomorrow?
Yeah, I mean, everyone's different, obviously, but it's certainly, I mean, if you and I won the lottery, we'd be out there probably buying something for sure. So that's definitely happening. The key is the expenditures. I like to look at, there's got to be a portion of the money, and we talk about this with the client, that can be spent on yourself, and that's healthy, and you have to do that. And you've got this windfall, emotionally you want to do that, but going out and buying assets that are not great for your wealth picture long term, that's kind of what we want to avoid. So like these, if you could buy a home or a cottage, or that's real estate, that's okay, it's going to appreciate in value, you can probably sell it if you need to down the line, but the cash flow is the thing. So if you got 5 properties, what's your monthly burn on your cash? So that the cash flow, you have to look at the cash flow when it comes to that. What's the portfolio generating? Are you still working? If you're not, how much are we sending you? And what's your burn on those new assets?
In your experience, have they taken your advice and stuck with it over time? Yeah,
I mean, we've had some success, absolutely, with our lottery winners, and we've got really good. And it's just a process of taking them through that. It is a process to win a lottery and to go through. Some of them, it's the first time they ever sit down with a portfolio manager, right? So if the first time you're sitting down with a portfolio manager, you're being explained what a stock is, what a bond is, what a preferred share is, it can be overwhelming. So we take our time, a lot of education, and we get there.